Confused on how to get access to higher yielding bond funds? You're in the right place. Let's talk to the man in charge of the largest actively managed ETF in the world. Brian Lake is global head of ETF solutions at JP Morgan Asset Management, runs the JP Morgan Ultra Short Income ETF, currently the largest actively managed ETF in the world. Also joining me, my old friend Tom Lydon from Verify. Brian, Ultra Short Income, $22 billion in assets, corporate debt, duration of 1 year or less, but the largest actively managed fund in the world. I was really surprised to see that. What do you own, and how did this fund become so popular?
Yeah, well, Bob, as we talked about, the rising rate environment has been the story of the year. And so investors are looking for new tools in their playbook. JPST currently yielding 3.2% on the SEC 30-day, 4.4% on its yield to maturity. It's only got a duration of 3 months. And so investors are using JPST as a place to hide out while they wait for the market to find its footing.
So this is invest primarily in a portfolio of short-term, investment grade, fixed and floating rate.
Yeah.
Corporate and structured debt, and you're actively managed.
Yeah, absolutely. James McNerney is the person running this portfolio. He's the portfolio manager. He sits within our global liquidity book, and so you think about JP Morgan, you think about our Fortress balance sheet, and James McNerney sits within that global liquidity book. They also do our money market funds, and so he's a very thoughtful investor around this, thinks about the risk, understands exactly what investors are using with this money. This is their safe money. It's a step out of cash, and he's very thoughtful.
And you move in and out. You have dollar exposure here, so you move in and out, right?
Yeah, that's right. Yeah, some people use it as a long-term strategic. Some people use it as a way to take some risk out of their portfolio while they're looking for things to redeploy into.
Tom, what do you think of all this? It seems like investors are growing more comfortable with cash-like ETFs than they ever had before. I've been talking about these short-term duration products all year. I guess this is what happens when you got stocks and bonds down double digits in a single year. These ultra-short duration bonds look like a lot safer bet to generate yield.
Yeah, Bob, you're right. I mean, short duration money market funds, CDs, were basically dead money up until about a year ago. But one of the good things about the Fed's hiking rates is short duration or money market funds are actually paying something now. So that's a huge benefit. And when you look at that duration being 3 months and the active management component and specifically what JP Morgan is buying, you can actually have a really attractive yield. And when you look at the volatility in this ETF, it's basically flat. They've done a great job of maintaining that net asset value, which is also key and critical. So if you've kept your powder dry and you're looking for areas where you can actually make some money these days, it's a great opportunity.
This makes a lot of sense, Tom. I mean, historically, bonds compete with stocks. We forgot that, so if I can get a risk-free 2-year treasury north of 4% right now, that is actually pretty serious competition for stocks.
It is.
History shows that yields will rise as growth and inflation outlooks increase, so these short durations are a lot more favorable.
And on top of that, Bob, the Fed's been really clear about their path to the future. So when you look at the fact that, hey, rates are going to increase, and as they continue to increase and JP Morgan implements this strategy, continues to maintain short duration, but now has higher yielding instruments to work with, we could get this up to 4%, and it's like the good old days, right?
Yeah, well, there is an alternative. We used to say, Tina, there is no alternative to stocks, right. And now there is an alternative, right? So we have, that's why you're getting inflows into your funds.
Yeah, if you think about historically, the risk premium for equities is about 4% plus a little bit of inflation, something like dividend. When you can get a 3.2 on the SEC or 4.4 like we talked about, that's actually pretty compelling. And if you're an investor looking at the next 5 years, maybe you want to take a little bit off and protect it in something like this that gives you that return without taking on some of that duration risk.
Yeah,
absolutely.
I also noticed your mixed managed, actively managed bond funds are really getting strong influence. So you have a core plus bond fund. JCPB is the symbol there. A lot of firms have these core bond funds that are mixed. This is actively managed, and you've got a sort of mix of investment grade, below investment grade, even distressed debt thrown in here. It's all actively managed. Corporates, there's some mortgage securities in there as well. So how do you do this? What's you're dealing with tens of thousands of potential investment. What's the current mix? How does it look? How does this fund look at this?
Yeah, so this is ETF Edge, and so we have to acknowledge that a lot of investors think first about a benchmark or a passive instrument. But when you're looking at a passive kind of fixed income benchmark, that's not exactly how investors really think about investing in bonds. They want it to be a ballast. They want it to be something that gives them yield. They want it to be something that has a low correlation to equities. And so when you look at JPCB Core Plus Bond, it owns all of those things that can be the ballast in the portfolio. But exactly to your point, Bob, it can go to below credit. It can go to foreign investment grade bonds as well, which can actually help boost that return and gives you the opportunity to get additional yield.
Tom, how many years have we been saying this? The active guys come on and say, wait till we have a lot of volatility. My heavens, we're finally going to outperform. We know what the long-term record is of active managers. It's generally abysmal. And yet here is a year where we've seen a number of actively managed bond funds actually outperform somewhat compared to their passive investors.
The pendulum has swung, Bob, right? We're now in a situation where with these higher yielding instruments, and even some that are deemed somewhat aggressive, where you have managers who've been in place for a long period of time, they understand the markets, they can go in, and for these short-term durations, because they hold them to maturity, even though they might be deemed aggressive, they know exactly what yield they're going to get if they hold that to maturity. And as shareholders, from a diversified standpoint, we benefit from that higher yield while they're maintaining a balanced NAV.
Yeah. You know, we had the fellow who was doing single bond ETFs on a short while ago, and of course people are loving this 2-year because he has the on-the-run 2-year. So basically, every month they have a new auction. He sells the old one, buys the new one, and people are getting 4%, real 4% yields, unlike other people who own older bonds in their bond funds, and everybody is happy. Of course, if this changes, if rates come back down again, you know, that's not going to be so appealing.
Yeah, I mean, look, the ETFs are tools for portfolios, and there's probably a use case for those. But when we're talking about like something like Core Plus Bond, we have a portfolio manager that's intentional about what bonds they're owning, evaluating the credit quality, understanding exactly what part of the curve they want to be on, and they're actively managing that portfolio to position it to do what it's intended to do within the portfolio. And so that's why we're seeing people use this as a core holding to balance out their portfolio. And over time, I think that's important. Again, compared to passive, where you're just dictated by what the index does, you can float all over the place, whereas you've got a portfolio manager that's keeping their eye on what they're actually trying to accomplish in the portfolio.